On this video, we're going to be doing a full breakdown on a completely separate strategy that I chose not to follow when I started investing in property in 2020. I'm going to do a full breakdown of it. I'm going to talk about it, and I'm going to go through my initial numbers of when I started to now and talk you through it on why it was the best decision I ever made in my life not to follow this. We're seeing this online a lot, not just from one person, from a lot of people. We're seeing that this strategy is superior. Okay, buy close to the Sydney CBD, buy units, make sure they're in boutique buildings, make sure that there's height restrictions and scarcity of stock. Okay, or buy houses close to the city that have growth rates of 7 to 8% on average, which is superior to the other forms of growth rates across the country. And I do agree that some of these areas outgrow other properties by 1, 2, or 3%. Okay, I agree 100%. But if I follow this strategy, as I'll show you the numbers, I would have blown up if I went through it, and a lot of people would have blown up if they did it as well. Okay, these kind of strategies apply to the rich that have a lot of money, the ones that are on really high incomes of 500 plus grand, that want to do a heavy amount of negative gearing, okay, and potentially want to build wealth through equity growth in property, but they're really okay with managing their lives and working until they're 55, 60, 65. They're not the type of people that want to get out of the game. All right, and if these people talked about this strategy in context, I would agree with them 100%. So let's go over my numbers and let's do a full breakdown and talk about it. And you'll see the numbers and you'll be shocked at what it is. So right now, on my screen right now, I've got a calculator that shows a 2.7 million loan, interest only, on a monthly basis, 30-year loan, and it's... So let's have a quick look. So the calculator we're looking at is 2.6%. So the monthly installment on this is 5,850. So we're going to dial ourselves back to the end of 2020, where the rates on variable, this was very achievable. And then this is kind of the entry point, and we're going to talk about myself. So back then, and just bear in mind that I run a business, so I can claim a hell of a lot of expenses if I want to on a given year. Okay, and my household combined income was around 210 grand with my wife. Okay, that was combined income before she stopped working. So we're looking at a monthly installment of $5,850, and I'm really guessing on where I think the max is that I could have purchased, maybe over a 12 to 18 month period, just like I've gone through and purchased 8 to 10 investment properties now, but I've used another strategy. So I had to kind of guess where I thought I could get to. So that's three $1 million units, assuming this kind of strategy is in the eastern suburbs or very close to the Sydney CBD, and we're doing 10% deposits on everything, and you can see that the debt is 2.7 and the purchase price ranges are around the 3 million mark. Okay, then we'll go to the calculator and we'll update it. So 6.85%. So that's where we sit now. And if I ran this strategy and I had 2 loans in the main tiers and 1 in the second or the third tiers, the blended rate would be somewhere around this, 6.85%. And if you look at that, it dials up to $15,412 on an interest-only payment, 2.7 mil, 30-year term, interest-only monthly. All right, so what we're going to go over is we're going to go over to my notes now. So I'm just going to change the window. Okay, so here's my notes, and let's go ahead and expand it and talk about it. Okay, so hopefully everyone can see this on the screen. So I'm going to start from the start and assume that I went through this strategy that everyone purports to be the best strategy out there for long-term growth, for building equity, financial freedom, and you hear it day after day. People should have followed this strategy. So let's buy in blue chip areas, right? They grow at superior numbers. 7 or 8% on average over a 30-year term compared to some other properties that are closer to 5 to 7%, which I agree. It's the superior strategy for everyone, right? Growth is the only way to financial freedom. You can't have high cash flow and high growth. That's what they say. So let's go through the mechanics on this kind of strategy and what I would have had to have gone through to even make this strategy achievable. First is, let's talk about the large cash out rules. So the people that purport to do this kind of strategy in the past were pulling 500 grand, $1 million of equity out, and they were doing it from pretty much every bank that they touched before 2018. There was no such thing as controlling of funds or responsible lending before 2018. If you had the equity under 80%, that's pretty much it. You can pull it out. Okay, and not just that, you can do pretty much whatever you wanted back then as far as the lenders go. Okay, now you've got lenders that limit you over 100 grand, okay, because they start assuming that you're going to be doing some dodgy stuff that they want to control. So I'll give you an example. A lot of people try and get 100 to 200 grand out and then do a large scale renovation when the banks don't like you doing that on your security. So as soon as it goes over 100 grand, they want building quotes, they want a building contract, they want, and if it's a large scale construction, they want to control it. They want to release it as stages. They don't want to give the builder the full amount, and they don't want to give you the full amount because they don't trust you. All right, then you got some banks that are a little bit better. So they'll allow you to get up to about, say, 250 grand out. And then you've got about 8, maybe 10 banks that will do up to $1 million, as long as your borrowing power is good and you're under 80% and you've got good conduct. Okay, so that's pretty much it. So unless you're dealing with those 8 to 10 banks, and those banks, not only match up to what you need on the cash out rules, they match up to what your borrowing power needs are and how your structures are, which may not line up. Okay, you might not be able to get the highest borrowing power with the lender with the best cash out rules that you need. So that's just one thing to think of. Then we have to talk about the tax implications of a large cash out. Okay, people will have you believe it's completely legal to pull money out of an investment property and then live off that money for day-to-day living expenses. Okay, so the loan goes up, you would get extra tax benefits, which is completely false. Okay, the ATO looks at the purpose of the funds. So to truly do this legally, if you pulled 1 million out, you would invest it in an ETF like VAS or IOO or something like that with a 7% dividend yield, fully franked. The loan would go up, the payment would go up, you would have a deductible amount of interest that you could have, and then you would live off the 70 grand income that portfolio generated, but then you would have a stock or an ETF or an index portfolio that had variations depending on the price in the market, so there's a little bit of risk associated with that. Okay, back before 2018, people were pulling cash outs and doing all this stuff with the ATO where they were living off the money. Okay, whether that's legal then or now, it doesn't matter. You can't do that now. You've got to speak with an accountant. So it's pretty much you've got to double invest the money and then live off the income of that money. Okay, that's pretty much what you got to do. So this whole fallacy of pulling $1 million out, having it as a cash buffer, and then being able to live off that as living expenses because that's growth that you've made in your portfolio, then you just can't do it. Okay? You don't have the borrowing power to get the money out first. You've got to be with the right lender to get the money out second. Third, you've got to make sure you're complying via the ATO to do that. Okay? And all these people are saying it's just dead easy and they're not going into the nitty gritty. Okay, so let's go to the next one. So negative gearing at a 49% rate. So let's assume you're in the top tax bracket. You go through 12 rate increases, okay, and no one knew this was coming, but my style of investing right now, I'm completely fine and stress-free. This style, 12 rate increases, I've already shown you on the screen what the repayments went to. They almost tripled, okay? Now you have to be able to survive the cash shortfall per property between tax returns to gain back half of the loss, or you are out of the game. So essentially, you need an extra 500 grand for this buffer, not accounting for actual living expenses as per the above. And the reason why you need such an amount is if the amount has gone up that much and the expenses have gone up that much, and you don't have 500 grand, which is pretty much 3.5 years worth of that loss, then you are screwing yourself. You are not accounting for at least a couple of years to get yourself in a good position to be able to control this type or style of investing. So if I was to survive, I would need to have a borrowing power for 1.5 mil of cash outs, which I didn't, be in the right bank for the large cash outs, make 1.5 mil in equity, so that's 1 million cash out to invest to live off the income. The other is make 1.5 mil in equity on 3 mil of buys. So you've got the 500 grand cash out, which is your cash buffer. You got the $1 million that you made in equity magically over 12 to 18 months, which no one made. Okay, you can't make 50% in that time frame, and those properties didn't do that anyway. So, and then you've got to get all this done before the rates went up. Okay, because if you didn't do it while the rates were low, the rates went up and then your borrowing power got capped and you couldn't take the money out anyway. So anyone that did this probably got caught. All right, so that's just things to think on. These people talk about these small little concepts on their TikTok videos and their 20-second clips, but if you go into the nitty gritty, it does not work. Okay, and they are getting you into a very financially stressful situation. So let's go to the next one, the DTI, so debt to income ratio. So back when I got my 8 investment properties, and just bear in mind, we're looking at this strategy as if I'm trying to income replace and get financial freedom. Okay, if they're constantly working and getting their income up, it might have saved them during this time. But that's not what I'm looking to do. I'm looking to get the growth, plus I want the income, and I want to be able to get through all markets, which I've managed to do. So that's why I'm focusing on this kind of strategy for a like for like on what I've done. Try and get the same goals in both and see if I can get the result. Okay, so the debt to income ratio was normal back then, was an 8 times income plus rent. So this is at the big 6, big 8 banks. So your income plus your rent times 8, you could pretty much get that at Westpac, CBA, NAB, any of the majors. Okay, so back then, 7 out of my 8 investment properties. Back then, my household income, and bear in mind I'm a business, so I can claim a shitload of expenses, combined with my wife was 210 grand. Okay, so this is coming back to my example of 3 properties at $1 million a pop, because I've kind of got to guess how many properties I could have gotten back then while the rates were low. All right, so let's say I could buy 3 times $1 million Bondi units in small boutique blocks that grow at 7% per year. Most of my initial buys were 90% LVR. Okay, so 2.7 mil of debt against 3 mil worth of property. Starting rate was 2.6%. Okay, in 2020 and 2021, interest only, 30-year term, 5,850 payment per month times 12 months in a year equals this figure, 70,200. Right, very manageable. Now I'm being a little bit conservative and helpful with the rent numbers, because I know some of these properties were only renting out at like $600 a week before the rents went crazy. Okay, so I'm using 700 a week times 4 weeks in a month, times 3 properties equals this amount. So just over 100 grand a year in rent. So the rent plus our income equals this figure. Times it by an 8 DTI, debt to income ratio, equals this figure. Okay, which is very close to the 2.7 mil lending that I needed back then in 2020 and 2021, right? So this tells me I would have had to have used 2 main tier lenders, and maybe a mid or a third tier lender for the third loan because I don't have the borrowing power high enough. Okay, so I'm barely getting there on the borrowing power back then. Now the max DTI range is 5.5. Okay, so it's very hard to get over that in the current market because the rates have gone up and a lot of the lenders add 3% on top of the rate, which screws your borrowing power when they stress test you. So let's assume the rents went up 20k, and I'm being very helpful with this strategy. Okay, because I don't want anyone thinking I'm using low numbers and I'm just trying to can the strategy. So let's assume the rent went up 20 grand over the last 2 years across the 3 properties. And I haven't even accounted for the huge amount of increases in expenses which have gone through the roof. So again, I haven't, from a situation, been too anti this strategy with the numbers that I'm using. Okay, so let's assume the rent went up over 20k over the last 2 years. So 30, that's the income, times the 5.5 DTI, puts us at a 1.8 million max borrowing power in 2023 August. Okay, and the rates go up to a range of 6.5% range on the majors, okay, and 7.5% on the mid-tier banks. So the average blended yield is 2 properties on the majors, 1 on the mid-tier. So the average blended rate is somewhere around 6.85%, right? 2.7 mil debt times that rate brings us to $15,412 per month. Okay, and yeah, amount of days in a year, it's off by a couple of dollars, but you get the picture. Times 12 months in a year, 184,944. So the question is, can I carry that amount before I blow up? Okay, so can I do that? Can I survive 1 full year of tax returns to get half of the loss back in negative gearing? As it's over 50% of my total income, I would say a big no, 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 no. Okay, so we all hear about if your rent or your mortgage is over 35% of your total income, you're pretty much in stress. If you're over 50%, you're in default, right? Okay, we're in default. So if I don't have huge amounts of $1 million in VAS giving me an extra 70 grand a year, okay, to offset this, or I don't have a 500 grand buffer to be able to get through this and the next 2 or 3 years minimum to be able to get out of this, I'm screwed. Okay, so we've got to talk about these kind of strategies and figures and numbers and stats and really go into the nitty gritty. The 7 or 8% is not worth it from a growth aspect. One, because I can't. So let's write this down. So one, why isn't this strategy worth it? Okay, so why? One, asset base. Okay, I can only get 3 mil in property, right? Okay, right now I'm on, with the granny flats, about 6 mil of property. Okay, and I'm going through at least another 3+ mil of buys in next 12 months. So 9 mil of property. Even if that property on average only goes up 5% a year, I've got the superior asset base. Okay, so I've got the superior asset base, and so it's 3 times the size. I'm going up at 5%, so I'm making more money, right? Then they say, what do I hear them say a lot? The properties go nowhere. They don't make any money. So that's a fallacy. I've already made, let's say, about 2.2 mil in equity. And when this market turns, I think realistically, once I get the asset base up, I'll make 4+ mil in equity quite easily with the same kind of strategy that I just replicate. In 2024 and 2025, I would be somewhere, because I might stop buying somewhere in 2025. I don't think it's unreasonable for me to be making about 5 to 7 mil in total equity by that point at a bare minimum. Okay, so could I have done that with with this strategy? The answer is no. All right. Then we've got to go through some of the other things, the cash flow, right? So a lot of them say that you can't get cash flow and growth, right? When I'm on average about 8% plus gross yield on debt. Okay, and this is me. Okay, and this strategy we're on normally between about 2.5 to 3.5% rent gross. Okay, so the difference at a bare minimum we're looking at is 4%, but the highest amount, so 4 to 5.5% difference. Then they're going to say, well, that difference, half of it goes away, right? Goes away to tax. Well, what happens if you're in a corporate trust? Okay, which is company tax rate. 30%, right? So you're saving an extra 19%, right? Extra in tax, okay, and margin on the gross rents, right? So we're not only we're getting 4 to 5.5% difference on the gross rent. Then they say, oh no, you're only getting half of that, so the numbers are minuscule. But really, when we look at it, and you're running it in corporate trust, which I am, you're saving an extra 19% compared to 49% to the 30% company tax rate, right? So then a lot of the fallacies that I hear that are talked about tell me that their strategy doesn't work and it doesn't apply to the majority of people. So it doesn't apply to the people that want income to retire. It doesn't apply to people that want to retire early. Okay, it doesn't apply to people that are not on huge incomes with cash buffers or the rich. And bear in mind, this strategy, I'm very pro this strategy if you're the right type of client with big cash buffers that just want to sit money for the next 50 years and know that you're going to do well on a growth aspect and get some tax benefits along the way. I think it's a great strategy, especially if you put a couple of renos in there and you do a couple of things there. But in reality, I'm showing you numbers that show that I would have blown up. So end of this, if I followed this strategy, I'm done, I'm dead, I'm blown up. Okay? So that's the end of the video. So I hope that I've given you a whole lot of things to talk about, and I like going through other people's strategies and talk about, the benefits here or there. Tell me if I've missed anything. Hit the like button, the subscribe button, comment button. I'm not dollar for dollar right on everything here. I'm out by 1% maybe on some of these numbers, and I've just done it roughly here. But this is just showing you why you can't just hear these short little excerpts on TikTok and YouTube Reels and not go into the nitty gritty of it and actually break it down. Okay, that's what I'm here for. If you need an appointment with me, hit the link below and we'll talk about this strategy and other strategies, talk about your goals that you need, and then make sure we're tailoring a loan strategy and property strategy that can get you to your end goals. All right, we'll see you on the next video. Take care. Bye.